You have now arrived at your destination.
Mike, this is such a joy to do. I've wanted to do this one for about 7 or 8 years, but thank you so much for joining me today first.
Thank you so much for having me. And I'm sorry that I didn't join when you first asked me, but I'm a slow learner, but I eventually made it.
Listen, it was only my mother that actually listened back then, so I think it was a strategically wise move for you to do. And for those that actually can't see and would see on TikTok, Mike has the most brilliant bookshelf behind him, which just shows how wise he is. But we're going to start today with Mike's intro. And so tell me, Mike, how did you make your way into the world of venture? And then how did you come to found Chalfen Ventures, obviously, most recently?
I grew up sort of quite nomadically. We moved around a lot, and I was very interested in sort of fairness and in sort of how the world ought to be, because wherever I went, I was a fish out of water and nothing seemed to be how it should be. So I did the obvious path to get into venture, which is I started studying civil rights history and got a fellowship to the US to pursue more history. And when I arrived, went to meet the guy I thought I'd study with, who said, I hate this career. I can't recommend it. I read your submission. You could spend your whole life doing that. And I cannot recommend it. Good luck. I'm going on sabbatical. So off I went and started doing two things, playing with the web a little bit very early, but mainly sort of going and hanging around at the business school and ending up at BCG, which I didn't enjoy. And I left, much to everyone's surprise, at BCG to join a venture capital firm called Apax Partners, which was then a venture firm, in 1996. So, I was sort of a believer in bottom-up change and that the web could enable it. And Apax was an unusual place at the time, partly because there were only 3 firms in London that did VC. But it was a very sort of strong analytical culture. From the beginning, I had to sort of do all my own legals, do all my own numbers, write my own recommendations. And so it's very good training, in fact, for what I did later and do today. Sort of learned the craft very well. And although the funds got very big, you sort of learned the value of that every dollar counted. Like, we didn't sort of walk away and just lose money casually, even though the funds were pretty big by the time I left after 10 years. But also it peaked at, I think I was the 31st and youngest partner, but it peaked at 41 partners. So there was a sort of, I learned quite a lot about big partnerships. And lastly, when I look back, I was managing my career rather than managing sort of the money I was investing, and everyone else in the building below sort of the very top level was similar. And, that was something, again, I only realized much, much later, but it was an unusual experience and really set me up well, both good and bad.
What do you mean by managing your career, not your investments? Just so I
Well,
understand.
if you're a mid-level person, if you were a mid-level person at Apax, you would do the right thing in order to look good, further your career, rather than optimize returns. Sometimes the two completely coalesced and overlapped, but sometimes they didn't. For example, there were winners that I invested in 2000 or 1999, and as this sort of upswing in the market happened a few years later, I remember very distinctly suggesting that we reinvest in one of those businesses. Sort of, I don't know, 80 or 90 million euros was the valuation, I think. And the answer was no, like, we're past that. We've left that one behind. We've moved on. And that ended up as a 1.5 billion euro outcome that Apax missed on because it sold. And I sort of didn't fight my corner, even though I had conviction. I just sort of went with it. That's an example of, managing my career rather than sticking to my guns.
Do you not find this a misalignment with GPs and LPs? We're just diving straight in. I much prefer a chat. Do you not find this misalignment with GPs and LPs today, though, where I often speak to GPs and I'm like, this company is a fucking winner. Why are you shipping it to tier one multi-stage firm? And they go, Harry, when I tell my LPs that X did this company of ours, I look great. Well, I don't give a fuck. I would like to have more ownership in that company and actually double down. But there is a misalignment there, no?
Yeah, I mean, I'm in a different position because, I don't have a growth pool of capital by design. So for me, the question for the company is what suits them best? Does a round with Chalfen Ventures piling in help them? What are the risks from their perspective? And let's rather than just what's my incentive, it's like what's best for the company is always the first question. And it may be, I'm having one discussion at the moment with a portfolio company where it may be actually the best thing is for me to price around and for the best possible co-lead to join and for us to crystallize that round. And that may be better than sort of a multi-stage fund investing kind of too early, which we've seen quite a lot of. But that sort of seems to be the alternative.
No, we totally have. Sorry, I interrupted, and I do just want to get to the founding of Chalfen Ventures.
There's no problem. It's okay.
So tell me, Chalfen Ventures, how did that come from Apex?
Yeah, so look, the first thing was becoming an angel. And, at Apex, the culture was, focused on the business rather than the entrepreneur. And as an angel investing day one, even very small dollars, as I did after I left, it's a sort of Damascene conversion. It was one of these sort of fulcrum moments where I sort of went from focusing on the business to focusing on the entrepreneur and the business opportunity sort of together. And that was a very important moment. And, when I thought about the lessons from Apex, I decided I wanted to go and be a partner at a smaller firm where I could have significant influence on the firm. So I thought I joined a firm called Advent Venture Partners, and it was hard to sort of move different people in and out of the firm to create the best possible team. And so I left, did more angel investing, sort of at more scale. And this is kind of an interesting period because without necessarily really hustling hard, I was finding very, very good opportunities. Like I was the first person to commit to Illumio, which turned into a very good business and investment. And, I led some seed rounds personally. I sort of realized that I didn't need to be at someone else's platform and instead formed Mosaic Ventures with a couple of people who I knew well. And it was a Series A fund when Series A funds were scarce on the ground and there weren't yet the sort of multi-stage funds in quite the same number as there are today. And at the end of Fund 1 at Mosaic, basically decided that almost having A/B tested it as an angel, I decided that I would really sort of prefer to work on my own at Chalfen Ventures. So that's what happened. I can sort of give you sort of more context if you like, but that's the story.
I totally understand your perspective there.
No, look, I mean, it's not actually about good and bad platforms. It's just what do you want to do and how do you want to express yourself? And we're lucky, you and I, where we can sort of express ourselves in our work. And I think there's a Freud saying that sort of love and work are the cornerstones of our humanity. And so for me, that's very true. And you can really express yourself fully in as a solo VC in a way that is a little harder as a partner in a firm and responsibilities to other people and building that firm. So that's sort of a big part of it. When I sort of go down a level, I wasn't that great at building a firm. And actually, I think a lot of VCs are not good at building firms. And I certainly decided I wasn't. There are people who are very good builders, they're operators, but they actually often join VCs because they don't want to operate anymore. There are people who do say they want to operate, but most VCs don't.
Why do you
And
think
those are the ones, who are capable. I wasn't good at building a firm. So I think if you take away all of those, sorry, Harry, if you take away all of those sort of activities, I can devote a lot more time to what I think I am good at, which is working closely with entrepreneurs. So that's sort of what I want to do.
Why do you think most VCs aren't good at building firms? I agree with you.
It's a very reflective role. You're sort of sitting back a lot of the time, deciding when to act and when not to act. And I think it's quite hard to sort of combine being very, very good at that, very, very good at supporting companies, and being a sort of operator with a plan and sort of who can lead large numbers of people or even a handful of people in one direction. So I think it's a bit of a mix of characteristics. I think don't always fit well with each other.
I mean, I think for me the biggest thing is because I'm building obviously more of a firm and a team.
Yeah.
Is a movement from like time spent. Like I used to spend all of my time investing, and now I spend half of my time investing because you're managing a firm and a team and everything that comes with it. It's a big transition. So I totally agree. Mike, I love so many things about our relationship. I think one of the things I love is bluntly drawing on your wisdom and experience, given my lack of. And so I want to start top down. We're going to move into Chalfen Ventures, but I want to start bluntly on the correction that we're seeing now. It's quite unnerving for many younger people who haven't seen it before. Is the correction as bad as it seems? And how does it compare to prior crashes that you've seen?
So, as bad as it seems is obviously in the eye of the beholder, but I do think that it's a pretty serious correction. I think it feels worse in a way than 2000 did because the reflexivity in the market is just much faster.
Yeah.
Stuff happens faster, and that's because of information flow and the web, like root cause. So I think it's hard to know whether it's worse or just things happen faster. So I think that's the first observation. If you sort of divide up a correction into financial and fundamental economics, sort of obviously the two are related, but yes, errors come out of the valuations of risk assets, including tech. In 2000, it was just tech and telecom that really had the air taken out of them. But the web businesses were very immature then. The cost of capital went way up, and they didn't have stuff like EBIT. And we now know today that the best web businesses can generate enormous profits. So the losses, the losses then were a little higher, I think, for most of these essentially public startups, which is what they were, than some of the businesses today. But there is definitely a sort of risk asset specific decline that we're getting today. And then what's I think harder to call, which is compared to 2000, is it looks like there's significant economic headwinds beyond tech valuations, which obviously it's all interlinked with some of the causes of the depression retreat in tech valuations. But between war and inflation and supply chain instability and there's a lot to take, and it looks like there's going to be economic headwinds for a couple of years. And in 2000, it was really a sort of our corner of the market was suffering, but the wider world didn't suffer in quite the same way.
Having seen the prior busts in the way that you have, and having lived through them as an investor, how does that impact how you think about investing today? And actually, Steph Kurgan, a mutual friend of ours, said, how does that change how you deploy today?
Okay, it's obviously two different questions. So I think my reflection on the sort of early busts is that good companies are still good companies, but it might just take longer and maybe more dilution for them to sort of come out the other side. And so it means that I no longer, I don't believe in sort of the fast payday. So that's sort of one, I've sort of mentally just don't count on timing. You can't time a winner. Secondly, and this is very fundamental, actually, very fundamental lesson. So I had two great mentors at Apex, wonderful people, Barbara Manfrey and Peter Englander. And Peter was my direct manager. And in 2001, when we were sort of catching our breath and wondering what to do next and which portfolio companies to save, he said, the first question is, would you put a single dollar into each of these companies at a zero valuation? And what he was asking was, is this a fundamentally good business? Or were you just playing the market? Were you just playing the dot-com boom? And that has always stayed with me. And that definitely has affected how I invest and how I think of which businesses to invest in, as that may not be fashionable, may not benefit from some of the sort of momentum in a wider market if there's a sort of bubble growing, but you're building real value. So that was a huge lesson. To answer Stefan's question on deployment, there are two different ways of deploying capital. There's first investments and follow-ons. So in first investments, I've definitely moved faster in 2021 than before or after. And I've sort of reverted to the mean, which for me is 3 or 4 investments in a year. But what I think I'm investing in hasn't changed. So, I'm still looking for the same kind of businesses, which we can talk about. But basically, I invested, day one to Series A in software businesses selling to business, and we'll talk about the different characteristics I look for, but I haven't really changed what I'm looking for.
Do you regret your increased pace of deployment in 21?
No.
Why?
I don't. I don't think that the proportion of mistakes was out of whack with a normal proportion of mistakes for me. So I still feel that there were some very, very good businesses that I backed. They cover still a range of different kind of go-to-market motions, end markets that they sell to. I don't think that any of them are selling to other businesses that are going to be significantly hit by the current downturn any more than the rest of the market. So I feel it's a sort of relatively robust crop that I happen to have picked relatively quickly. And then the other way of looking at it, by the way, is, am I doing them a disservice by investing a little faster? And the answer is no, again, not really. I feel I'm sort of devoting the right time to the companies and to the entrepreneurs that I sort of promised my time and sort of service to.
I know, Mike. I've had the joy of working with you. You put craftsmanship at the center, which is a little different to my approach.
You're a craftsman, just
Yeah, absolutely. I mean, what was it? It was, who said it? It was like, if Warren Buffett and Lance Armstrong had a love child, it'd be Harry. Which I thought was quite insulting.
I'm not sure you're that old.
No, this is true. Tell me though, we mentioned kind of the advice you've given me over time. We think about, this new generation of investors who are seeing this crash for the first time. How do you advise them? How do you talk to them in seeing this crash for the first time? And how do you solve their insecurity?
So if you probe carefully enough, most people were feeling insecure before the crash, but obviously it's come to the fore. Look, I enjoy mentoring. So, I had these live conversations I have not only with you. I don't want to sound sort of promiscuous as a mentor, but I do enjoy it. And sort of what I've been trying to communicate is you're not alone. And that there's a big difference between being uncertain, which is completely natural. And in fact, it's built into the experience of being a VC or an early stage entrepreneur. Like, there's a difference between being uncertain and insecure or anxious. And you can embrace your uncertainty, and actually that, if you face up to it, can reduce the level of anxiety. So that's the first point. The second point, I think, is that you need a framework. Everyone needs a framework. But you need a framework to figure out which way is up, which companies am I going to spend time with, and why. And again, if you create a framework that makes sense to you, everything else flows from that, and you no longer have to look at every single decision by itself and sort of be a first principles thinker every single time. Now, you'll still find that there are some situations that don't easily fit into the framework. And it's not a bad thing. It just means it's forcing you to acknowledge you might be about to make a decision which goes against sort of what you set out as how you do things. And that may take a different level of conviction to break your own rules. But if you embrace uncertainty and you have a framework that allows you to sort of understand where each company fits in your world, and if you communicate early with your portfolio so that everyone's on the same page and understands the reasoning for that, then you just are systematically reducing the opportunity for excess anxiety as opposed to completely legitimate, not legitimate, but completely understandable uncertainty.
You said there about embracing uncertainty. I do want to ask, I had Keith Rebois on the show recently, and he said his acid test for whether he's still a good VC is whether at least half of his friends laugh at all of his deals. Would you agree with that?
Well, it depends what your strategy is. I mean, there are businesses that aim to take share in an existing market. Often it's just a more efficient service or whatever it may be. There are businesses that aim to create a new market. And sort of if you're at the create a new market sort of end of things, then quite often it will appear to be completely strange. But I learned early in my career that any business opportunity where I or my partners thought was a very good service that they would definitely use, that was almost certainly addressing way too small a market opportunity, right? So really what Keith has discovered is that his friends don't represent a big enough market opportunity, which is probably true.
That on-demand helicopter service through Miami really is a big TAM these days, Mike. I think you're mistaken.
You know much more about that than me, Harry.
Sadly, I don't. I mostly sit in Fulham these days. But I do want to move to Chalfen Ventures and one kind of layer deeper. And when we chatted before, you said to me Chalfen Ventures is the solution to a problem. What did you mean by this?
There's two different things about it. One is that I think Frank Rotman from QED captured it about solo VCs, that sort of we deliver quite a lot of bang for buck. We should deliver a lot of value compared to the dollars we invest. So I think it's a product that entrepreneurs want, and they know that by having someone like Chalfen Ventures, a firm like Chalfen Ventures involved, we're not going to try and dominate the cap table for the next 3 rounds. We're sort of giving them maximum advice and help and support now, and then hopefully setting them up for success. So that's the sort of product I think entrepreneurs would like, and enough entrepreneurs. And then in terms of what it means financially, it means that I'm not trying to own 20% of every company. I'm not trying to dominate each round. Most entrepreneurs have a specific sort of set of goals for a given round, especially early stage. Like, what are the milestones they want to reach? Why are those the right milestones? How do we get there? And they ought to craft a syndicate around those goals. What's a syndicate that will support them in reaching those goals most effectively and efficiently? And I may say, look, I'd love to be your only investor, and this is why you might pick me to do that. But there may be a better solution, which is a split round, or you may decide that you just want me as a follower. Like, let's just talk about what your goals are and what the best round is as a result, and how does Chalfen Ventures fit into that becomes a derivative rather than the goal of the question. Then you're problem solving together from the beginning, which is how it should be. So quite frequently in the last year or two, I've made offers, issued term sheets to companies saying, I can underwrite the round, and I want to invest at least X, which is typically half. And so they've got a choice. And actually what's come back is probably half and half, where entrepreneurs wanted me to take a whole round, and half the time they wish for me to share a round with a very different kind of investor. So that's what I meant by that statement.
I always say to founders, actually, kind of construct your cap table like you would a sports team, and every person has to be world class at just one thing. I think people also try and solve for too many things in one person, but if you have 5 different people, actually you can solve for many different things. So I totally agree.
Yeah, and actually when you say 5, it's interesting. So like there's been this fashion of inviting lots of angels, and you really want to know exactly what each person is going to bring, whether it's a fund or an angel, and you've got to sort of ask them, what will you do for me, or will you do this one thing for me? And as long as you know that, then it's great to have someone on the cap table. But I think I suspect not every cap table is created like the team that you just described.
I always say it's lucky number 7. You have one lead, you have one smaller fund, and then you have 5 angels, and that's it. You have a WhatsApp group, and that's how you communicate. Ideal, I think, but changes according to different environments. I do want to discuss, many different elements, but I want to start on your picking. Mike, you have quite concentrated funds. You are clearly very good at picking. How do you think about the right number of lines in the portfolio and the right level of diversification?
I agree with what Oren said on the show, that LPs don't need diversification. Like, they get it naturally in their portfolio. So it's really a question of what's the right construction for the fund. I was talked a little bit earlier about having no real regrets about sort of what I'd invested in 2021. And what I was saying was that there's the right mix of end markets, go-to-market vectors. There's freemium, there's small business SaaS, there's marketplaces. There's a range of there's enterprise sales. There's a sort of range of go-to-markets. And, I think what's important to me is that you sort of have a reasonably sort of anti-fragile portfolio construction, not by virtue of having 30 or 20 or whatever number of investments, but by virtue of having different kinds of risks that you're taking with your investments. So
what are those different kinds of risks? Is that different verticals? Is that different go-to-market motions? Is that different stage? Because there's many variants that it could be.
Yeah, it's all of those things. Less stage, because I'm naturally a sort of seed C2 Series A investor.
Yeah.
It's also, however, how much capital is required to learn. So that matters a lot. And it's also how many investments require a completely new market to emerge. So I think you've got to have markets, you've got to have some investments where that's a question. You actually don't know if the market will emerge. You may have a hypothesis as to why and why now. And then some markets where you're attacking a large market which has, for some reason, vulnerable or weak or lazy incumbents, or incumbents with incredibly high margins, which are beautiful to attack with tech businesses. Brazilian
banks, the worst. Tell me, how do you think about market timing? You mentioned that kind of going after new markets. How do you think about market timing? It's always one that I'm afraid to take risk on.
The web is such an incredibly efficient discovery mechanism for needs that you can usually find some kind of indicator as to whether there's an unmet need that exists, even if it's not called a market yet. It's not coalesced into a kind of clear market. So, I've got one company in stealth where its service hasn't been announced. It's sort of, you've got to really hunt it down to find it, and then you need to describe how you would use the service as a customer before they decide whether they can help you and want to engage with you on a sort of private one-to-one basis while they sort of build and perfect their product and their onboarding and make sure they're adding value. And that business gets about 25 inbounds every day of businesses. So like that's an unmet need, right?
Mm-hmm.
So I think there are ways of triangulating these unmet needs. I think if you're talking to yourself and you're persuading yourself that there's an unmet need, I would sort of catch that.
Going back
Does
to
that make sense?
Yeah, no, it totally does. Going back to the diversification, just so I know,
Yeah.
traditional like venture portfolio theory suggests 25 to 30. For you, where do you sit in terms of number of lines that you feel comfortable with?
Yeah, so it's 9 or 10 investments in a fund, core investments.
Okay, so what does that look like on a capital concentration per company basis? I remember having Brian Singman on the show, and he said the great line of capital concentration limits, the enemy of great returns. What does that look like?
Like within the sort of day one to Series A kind of bracket, day one, it might be a sort of $1 to $3 million first investment, and a Series A could be up to 8 from my funds. And so that's the first thing. The second thing is, from a follow-on perspective, how quickly can you learn whether to really concentrate on one business? So I think you wouldn't want to get over, I don't know, 10% of the fund, 10, 11% of the fund with the first check, my view. But if you can pick 2 businesses which you want to become 15 to 20% of the fund, then that's sort of a very positive outcome.
Can I ask, Mike, my biggest fuck ups in venture have always been, no, I'm not putting in more money. Have you seen the price on that? That's crazy. And I've missed the next round, and the next round turned out to be cheap. How do you think about reserve allocation, reserves management really efficiently today with all the years of experience that you've had, respectfully?
You've got to believe that the new money is 10x money. I do. That's how I think of it. And if it's not, then you need to understand whether in the portfolio you've got, whether a sort of more growth return of 3 or 4x or whatever the number is has a place in the portfolio.
So I get you. Sorry, I'm interrupting again. But I get you totally, and I'm with you on the 10x. But it's not always that simple. And I'm a founder. To you, my investor now, Mike. I need you to put in another $1 million. It really signals a lot to the rest of the syndicate, and it signals to new investors. Come on, you led the last round.
Right. So it's very rare. So it's very rare that the answer is this is never going to be 10x. So it's about probability weighting. So I'm very unlikely not to contribute. I'm much more likely to put in an amount that suggests what I think the return opportunity is. So the reality is that the fund, sort of small solo VC, well, I'm not expected to lead the next round or hoped to lead the next round typically. So by sort of removing that possibility from my funds by virtue of size, they're sort of sub $100 million. I'm under less pressure to invest a lot in the next round typically.
I'm just using this for advice now. What do you do when you lose trust in an entrepreneur or lose faith in their ability to execute? How do you communicate that? It's not like a relationship where you can walk away. You are
No, for
invested.
sure.
What do you do?
Well, I mean, how I work generally with early stage entrepreneurs is we're in touch pretty frequently. So there's typically we have typically a weekly or bi-weekly call, and it's a standing call. And most of those calls are devoted to what is a problem that we're trying to address rather than updating me. So it's like 30 seconds, 60 seconds on quick update. Here's a problem we're trying to deal with. So both ways, there's openness. As a result, just that cadence. The entrepreneurs are not constantly in sales mode. Like, they're sharing, and we're hopefully resolving problems together. So when a problem comes up, which is a performance problem by the founding team, amongst the founding team, you sort of first of all need to start by saying this is a hard one. You acknowledge it's hard. You sort of say, look, here's some things I've learned. This is how I've learned it. Do we agree just on that? And you can sort of say, look, this is now, it's a shared problem. It's a problem for the company. So what's the best way to resolve it? And you sort of, you rightly, I mean, it's not just presentational matter, but you rightly sort of present it as a shared problem. And, you need to sort of get well plan for the company. That may involve,
I don't trust you anymore.
Why?
How do you say that to an entrepreneur? It's fucking hard. I'm going
No,
through
I
this.
don't.
I'm going through this now, but
You don't say I don't trust you anymore. You say this hasn't happened, and that's a problem. It's just facts, and you say it with empathy. You say this. I understand this is hard, and then you sort of make it their. It's like it's a decision maybe that they need to take with their team about how to reallocate responsibilities or give them the support they need to perform better. But you sort of give them a window of time to sort of resolve matters. And the answer is you've got to give people their dignity, right? So you find a way to do that.
You said you said about feedback with empathy there and understanding.
Yeah.
The thing that strikes me there is parenthood. Actually, listening to you, obviously I know you have wonderful children. Did becoming a parent help you communicate with founders, be more patient? And how did becoming a parent change you as an investor?
So actually quite a few things changed me, not just being a parent, but a lot of things fed into it. Like one problem, so I think even more important than parenthood actually was just significant things going wrong in my life. So in a short-ish period of time, unfortunately, my father died very suddenly, quite young. There's the sort of dot-com bust, and sort of I had been the glory, not the glorious, internet kid, but like the king of Apex internet, and that was all wonderful. And then it turned out I was a prince, and it turned out I was the pauper. And I got divorced, and then dumped. Like Apex fired me. So, and it was not personal; it's just to do with stage. But like you go through like a period of time like that, and you don't do things from a position of feeling like you're better than other people. Like life's a great leveler. What worries me in the venture business to a degree is people for whom nothing's ever really gone wrong, and life's been pretty easy. And so I think going through those things that I described was incredibly impactful, and sort of my ability to start with the people in the room and understanding what they're feeling like, rather than just sort of analyzing the situation and telling them the answer, which is rarely the most effective path to communicating well.
I don't know how bad it is of me, but there are some questions I would love to ask on the back of that, which makes
Okay.
me, I feel like a vulture journalist now. But it's like you mentioned, like Prince to Pauper, and like being in the heyday of heydays
Yeah.
back at Apex. Was ego management a problem for you? You were young and you were doing really, really well. Was ego management challenging, and how have you learned to control ego over time?
It was definitely a problem.
Mm.
There were very tiny differences between me and other people who were on the way up in the organization, and I'm not sure I always wore that. I think those people felt the differences more than was appropriate, and I probably also did. So that created tension. I was dealing with more volume than anyone in the building had ever experienced. In the .com, like this, the pace of company creation was pretty intense, and that was I was under a fair amount of pressure. I had 2 small kids. My marriage wasn't great. Like, I was definitely not sort of optimally placed to sort of have perspective on life at that time. And it was definitely a problem. And what made a difference was actually one of the most experienced people in the business, actually an operator who became a very, very good investor, a telecom investor called John McMonigal. He's called me into his office and said, I just want to talk to you because I think you're very good, but if you continue as you are, that will be less important than sort of whether we want you to stay here.
What did
And
he
he
mean
was
by
very,
what did he mean by continue as you are in terms of the high volume, fast pace?
no, in terms of sort of behavior with colleagues.
Ah.
And it wasn't senior colleagues, it was sort of peers.
Mm.
So, it was very helpful. And he wasn't sort of, he didn't say, look, this is a terrible threat. He's just saying, like, just calm down. Just calm down. And it was very well taken.
Did you believe you were better than them? And the trouble is, and I'm asking this because I see a lot of, the younger generation of VC at every fucking conference, at every event, at every dinner. And I've been successful, Mike, because I sit in one room and type and continue to type and then go to bed. But I look at them, I'm like, actually, I do work harder. And actually, sometimes I do think I am better, which is wrong. You're not. But do you know what I mean? Like, did you think you were better?
Well, you've put yourself in a position where you're the best person to what you are doing in various ways that we could talk about if you wished. 20-minute VC is exactly what you should be doing, both as a media platform and as a fund. And whether I felt I was better than people or they felt they were better than me, which I'm sure happened a lot. Definitely a couple of people who were normally 1 or 2 years behind me at Apex sort of said over drinks, I just don't understand what you invest in. What's that? What's this? It's kind of crazy. So there's definitely two-way street. The question is not, am I better than you? The question is, given what I think I'm very good at, is this place the right place for me? And actually, a lot of the last few years at Apex, when Apex scaled, and I ended up, I think, as the last remaining venture-focused partner in what was becoming a growth and buyout and then a buyout shop. I was sort of isolated, and I shouldn't have been there, and it was right that I didn't get to stay and that I left. And the beauty of what you and I do is that we're doing exactly what we should be.
I totally agree. Can I ask, you mentioned leaving Apex there and kind of Apex kind of firing you. So much of our identities are tied up in what we do. Did, did you find that challenging from an identity perspective?
Mhm.
And how did you deal with that, Mike?
It had been a long time coming just from a stage perspective. So it didn't feel unnatural. It was nevertheless pretty hard. Um, we had the conversation. I think I was doing jury service, and I was perhaps uncharacteristically quiet that week. But I had a coach at the time who kind of really helped me figure out that it was just a fit problem. It wasn't like there was something wrong with me. It's just there was a fit problem. What I was and what Apex was becoming and had become. It's two very different things. So it was okay from an ego perspective, but it wasn't easy. But it was okay.
Yeah, I find so much of kind of what we do is tied up. Our work identity is tied up in our personal identity. That's why I hate going on holiday, because then I just don't know what to do or who I am. I do want to ask, Mike, when we think about kind of how you changed as an investor over like 20 years,
Sure.
have there been 1 to 2 professional things that have changed the way you are as an investor? Often it can be the most painful or challenging, the catalysts.
Yeah. So I think the dot-com crash, that being faced with like, is what you have invested in actually a good business? Like that was very, very tricky. That was a very, very important question. And as part of that, I remember turning down, in fact, not one, but two entrepreneurs. So there's this company that was these two companies that were competing, they decided the best idea was to combine. And it was two entrepreneurs who were good and would be complementary. And for the combination to happen, all it was going to take was for Apex to say, yes, we would put from a very large fund, from a 1.8 billion euro fund, that we put €1 million in. And these two entrepreneurs were Mark Schuster from Upfront now, and a guy called Metin Negrin, who I respected a lot. And we said no. And that was my recommendation, was not to put $1 in. And it was a mistake in the sense that Mark built a business. And it was probably not a mistake in the sense that where we did concentrate capital ended up as bigger, more valuable businesses. That's a very hard discussion with entrepreneurs who were very good. So that was a sort of painful moment.
Did it change you? Like, did you change anything about the way you did this role?
Yeah, it made me more upfront. Like having gone through that, there's a big difference between someone building a business and someone building a business you think you should put money in. And but the most important thing was being very upfront about it, and it was a very sort of clear decision process, and it was very hard. And it wasn't even because I didn't think they were going to build a good business. It was just a business which fell below others where we wanted to concentrate capital at a time of scarcity.
Do you think VCs are upfront today?
It's very, very hard because it's such a social business, and there are referrals, and people take blind references, and should I work with this person? And I think there's a lot of smiling and nodding, and it's just part of the sort of, it's part of syndicates coming together quickly. It's part of rounds happening quickly, sequentially for companies. It may be that in the next year or two, we all are a bit more upfront because we kind of have to be.
Yeah, I hope so. I've become a fan of the direct comms a lot more over the last few years.
No, you've been very helpful to me in that respect too. So yeah, you are practicing what you preach.
Not at all. I want to dig in on something in particular, which a lot of like our mutual friends said. I mean, specifically Richard, Trey, and Charlie. But it's Bluntly, when a lot of others pass, you dig deeper. And so I just want to understand really your mindset around what does it take for you to turn over another card when others don't want to and will go, no, on first glance.
So sort of diligence wise.
Yeah.
So to me, the question is sort of when something's not obvious, can I imagine how it could become very, very interesting and possibly dominant? Right, so very different and possibly dominant. And that's always worth a look. So I probably wouldn't take another look if it looks like it's the 10th business making Salesforce data more freely available to salespeople. I mean, or whatever it may be, that's a sort of where there's a low barrier to compete. But if I think that a business genuinely has a different view of the world, ideally both in terms of its technology choices and the business outcome that's possible for customers, that's worth a look.
How do you think about outcome scenario planning? The big lesson I have from speaking to some of the best is you can never predict the size of your winners, in which case, surely outcome scenario planning leads you to the wrong decision.
Very acute question. I think that's true. However, I think that there are two different kinds of good businesses that broadly that we could invest in and support. One is a business that you just don't know how big it will be, but the economics are going to be very strong. And that's just got it's got a fundamentally different trajectory than a business which needs to be very big in order to have spectacular economics. And I think the mistake in the last couple of years in our market has been a lot of businesses that could be good businesses at prices if they could be enormous businesses with unbelievable economics. And so they've been missized in terms of their cost base as a result, because they've been overcapitalized, therefore missized in terms of their cost base. And then we're in sort of a world of pain as investors, and founders suffer as a result. Employees don't make the money they could have made if they'd sort of taken different decisions. So I think if we categorize those two right from the start accurately, then that helps a lot in terms of not being over specific in terms of outcome planning. But you sort of say, I know that this is the sort of business which, if it's doing well, I won't need to put endless amounts of money in. And if it doesn't become that big, it'll at least compound very, very profitably. So an example is a winner for me from 11, 12 years ago called The Foundry, which was making 35 or 40% margins when it was really not very big. And it didn't grow that fast, but it produced 40% margin, 35, 40% margins for 10 years, growing at 30, 40% a year, requiring no capital. And that's a sort of very interesting model. You need to know, I mean, that's not a great investment necessarily for a huge fund, but for most funds, that's a really interesting model. Ideally, they're growing faster than that, the businesses, but that's sort of a different point. And then there are businesses where which are real moonshots. And the trick there is, I think, not getting sucked into imagining that they're sort of huge and ready to scale when they're not. And that's a way that the whole market, in my opinion, in the last 2 years has sort of overfunded businesses as if they're ready to scale. And, if only that money had been held back for a year or two, then maybe it would have been a great decision to capitalize them well. But unfortunately, we sort of, I think, as you said, foie gras them.
I mean, at the core of both sides, really, is unit economics in terms of what builds a sustainable business or what doesn't. Yeah, this is
Yeah.
something where you've been incredibly strong. I do want to
Mhm.
kind of double click on this because I don't think that our generation actually fully appreciates and understands unit econ to the extent that we should. How do you approach unit economics? How do you look at them? When's the right time? Can you just walk me through your thinking around it?
Good unit economics basically mean you can ultimately, at some point, choose to control your own destiny. What it means is that there's some size, whether it's 10 or 50 or 100 or whatever $1 million of revenue, at which point the company could choose not to rely on capital to grow.
How much does
My view is poor unit economics mean you're always relying on the next investor and ultimately the greater fool. Now, most businesses, to your point, most businesses don't know if they have good unit economics at very early stages. But you can sort of imagine what good unit economics would look like for a given business. So, if you have an enterprise software business, applied AI for a given sort of process in the semiconductor industry, if it's addressing an acute pain for fabs, then and if there are very few competitors to that business, even though it's got long sales cycles, and after sales, you need to prove that the technology delivers value to customers. You can imagine that once that's proven, really not very many times, the sales cycles and rollouts will happen relatively fast. So you can sort of imagine what good unit economics will look like for that business. I'm giving you a deliberately sort of specific example that's sort of relatively obscure, but it's not even with a type of business which the broad market doesn't sort of associate with good unit economics. You can imagine what good unit economics looks like for most businesses, and then you can assess whether the conditions required for those unit economics to obtain, whether those are really likely to emerge.
Can I
So
ask,
does that make sense? So you're not looking for proof of unit economics, but you've got to imagine all the levers clicking into place so that good unit economics emerge over time.
I'm totally with you. I think in terms of predictability, it's much easier within enterprise. Consumer is just so variable. I do want to ask, has there been a time when you got it wrong? And why did you get it wrong? It could be either for the better or for the worse.
You mean unit economics?
Yeah.
Specifically. Yeah, I mean, I think businesses that start as services, and the objective is to build out, use the service process to build out software to automate. I think that's very, very, very. I found that very hard to do, and so I've invested in businesses like that a couple of times in my career and just got that transition completely wrong.
Where do they fail in that transition in terms of just productizing it entirely, and then it just stays as a low margin services business?
In enterprise in particular, a lot of larger businesses actually want services. Like there's a reason Workday and SAP have big services lines. Like the customers want the provider, the vendor to really hold their hands and make sure that value is delivered. And that's sort of the underlying, that stickiness is an underlying reason why it might be hard to automate something, even if you wish to, even if you could. It's very hard to get away from that sort of client need.
I do want to touch on one final thing before we discuss boards and then do a quick fire. And it's
Sure.
FOMO. FOMO dictates so much of this industry. Now, I'm riddled with FOMO. I mean, it's incredible how many misses I have for my short career. Really, I'm talented in this respect. My question to you is, when we chatted before, you told me you do not have FOMO. Like, how do you avoid it? And help me out here.
Look, Chalfen Ventures is a solo VC. It's just me. And I don't want to have a lot of noise in the system. I don't want to be sort of chasing every possible investment, because then I can't provide the service that I think is at the heart of my business to the entrepreneurs that I work with. So it's a sort of business choice. It's a business model choice. And if I didn't feel I could find differentiated, potentially large businesses that other people don't necessarily see, either at all or see as attractive when I invest, then, without seeing every possible investment, then, I shouldn't be in the business. But I do feel like that. And so it's a sort of combination of a business model choice without which being a solo VC, I think, is just not possible. But also the sort of being content with my strategy and how I operate. If I wasn't content with it, which obviously is partly a question of not sort of aesthetics, but producing results for LPs, then maybe I'd suffer from FOMO sort of more often. But when I look back on my career, what I found interesting, and maybe my partnerships supported weakly or didn't support or invested in with my own money, has been, on balance, pretty interesting. And so I'm sort of reasonably confident that what I see will produce stellar results. And so I'm sort of at peace with that choice.
I wish I had your piece. I'm permanently paranoid, Mike. I think it kind of pervades about 80% of my thoughts. But I think it's good at this stage. Actually, I think it's about being hyper competitive and hyper curious, as long as it's relatively healthy. But I totally.
But I think you've got to be competitive within your own sort of, on the field you're choosing to play on. So, I'm not uncompetitive, and I'm definitely not uncurious. But, I'm happy with the trade-offs I've made.
In terms of, like, as you said, the trade-offs you make there, you choose to do a board seat role often, which is a question now that a lot ask whether they do or don't.
Mm-hmm.
I've sat on boards before, Mike. We've sat on boards together. I don't think boards add much value, and I know that's a sweeping statement. How would you respond to, do boards add value?
Well, do they add value, and do they add the right value at the right time? So my view is that at seed stage, a board is of limited value. The most value is weekly, bi-weekly, spending time with teams, helping them solve problems quickly so that they're not waiting for the board in order to say, by the way, I've got this problem. And the cadence of the board is often a sort of, determines the cadence of reflection by the team. And so at seed stage, I think a board is negative. Even if it's a helpful board, the most valuable thing happens frequent cadence outside the board.
Yeah.
So, and then when a board becomes sort of more useful, partly perhaps because there are more investors involved, but mainly because a company's plan is clearer, I think too many boards are talking shops, but even good boards, I think, are inefficient. So, with a board, you want to clarify any factual questions up front. Then, so information should come out early, factual questions clarified, and then sort of agenda reprioritized according to what feedback is on what the big issues appear to be. And then you want to focus the discussion on those issues. It shouldn't be a reporting sort of forum. So I think that's one of the reasons why boards aren't very helpful, is that they're misconceived as reporting forums. And you should really split apart facts and reporting from the strategic issues arising. And that's where you should focus your time. And then, a lot of boards, there are people who are sitting around the table very quietly, and sometimes they're firm or they could be very helpful on a given issue. And I think that we don't always look around the table as a tribe. We don't always look around the table, VCs, to sort of determine who around the table is the best person to help with this one problem, either because they know it or because they have a portfolio company who's particularly strong in this area, or who had the problem and overcame it. And I think there's a lot of suboptimal sort of resource offers that result.
Oh my God,
And then,
the amount of useless intros that get offered to pretty useless people, and you're like, this is one more on introducing another. This is going to be valuable for this founder's time. I'm intrigued. You sit on boards with very young people. What's the biggest mistake that you see young board members make?
not distinguishing between opinions weakly held or strongly held, and not distinguishing between advice that they are in a good position to give or not in a good position to give. And I think it's just we should all, it's not just young investors, we all sort of slightly miscategorize that some of the time. So, I think being very clear when you've got a question and you've got an opinion and you've got advice, those are just three different sort of epistemological kind of categories.
I think it's helpful to categorize it in that way. Speaking of kind of the time allocation and where you focus your time, I think one thing that I do struggle with is the head and the heart of time allocation in venture, which is the head says spend your time with your winners, helping hire a head of sales can move the needle for the company in your portfolio. And then the heart says, actually, it's really hard sometimes and you can't just abandon companies. How do you think about time concentration across the portfolio? And do you have to concentrate time into winners?
So you need to develop a good enough relationship that when companies mature, it's okay for them to spend less time with you and okay for them to pull you in when they need you. So I think people talk about rounds as sort of the natural demarcators of when an early investor may start to spend less time with a company. In my experience, it's actually not about the rounds, although it's related. It's more about the maturity of the team. So if you have if you're a CEO and there's a co-founder and you don't really have a team, the relationship with the early investor is super important. But the more competent people you have around you, the more you inherently bring decision making into the group, and you start to distinguish between stuff that happens inside the business and sort of working on the business, and the investor perspective is working on the business. But in those early days, the two kind of really get mixed up. I spend less time with winners because they don't need me, because they have good teams. But when they come to me with a problem, it's usually a problem that I'm best suited to deal with, and we can really go into it. So that's sort of my experience. And where you want to spend time because these are your winners and you want to feel like you're making a difference, like that's not a good way for the company to get value from you. The company should basically determine when they want to talk to you. And actually, I'm going backwards now, the conversation, but by the way, with boards, like what drives me mad is everyone's accruing the right to be on the boards round by round. One or two board members get added. There should be a statute of limitations. Like after 3 years, you no longer have the right to be on the board. Boom. And then if the team wants to invite you back on the board, that's great. And if you're an early investor, they may not exclude you from the next board. They may determine that actually the Series A investor is just not very helpful. And so they want to lose that person and keep the seed investor. I mean, it should be up to the companies.
I totally agree. I totally agree.
Sorry to sort of go back in the conversation, but I do have a bee in my bonnet about that one.
Not at all. The final question for a quick fire. I find it quite unfair sometimes for first-time founders to know how to prepare for a board. As a board member, what do you want going into it? Do you want a 25-page deck? Do you want a one-page, this is my 3 biggest questions? What do you want to come prepared to the board in an optimal way?
It depends. So there are founders that are very good at saying, here are the 2 or 3 big problems right now. Yeah. And this is why these are the big problems, even if numbers 4, 5, or 6 may look important to you. And there are some founders that really aren't very good at that. And so I think setting the board agenda with the founder is kind of important. And what we should discuss is a direct result of the problems that they are encountering, or that they can see coming over the hill. And I think most first-time founders are not that good at anticipating something that will be a problem in 3 to 6 months. And I think that's probably where you and I can be the most helpful in sort of ask them to think that through. So that's probably where I would ask the most questions compared to the material I'm being supplied with.
Do you know my biggest lesson is the weight of words being uneven across boards? And what I mean by that is if you're on a board with Alfred Lin or Doug Leone or Bill Gurley, or you name these guys, and then you comment in real time on a Google Doc, when they comment, it takes a very bold person to comment back, totally disagree with you, Alfred, on your views on liquidity within this marketplace. And so what I always suggest is like comment in an isolated Word doc, then you, the founder, can bring everyone's independent thoughts pure and then discuss them in the board together. And I find that the best level of discussion, actually.
Yeah, I mean, it's then up to the entrepreneur to disagree with Alfred if that is the correct path. But I think, an intellectually honest discussion is sort of saying, either I don't understand why you said that this is the most important point, Alfred, or this is why I disagree, and then you can go at it.
I think they should. I think the biggest thing that worries me now is just like continuously asking for permission. It's like, you do what is in the best interest of your shareholders because they trust you and they invested in you, but don't go and ask for permission to hire a head of finance, for Christ's sake.
Mm-hmm.
Sorry, I'm getting on a high horse.
Is this by any chance a current topic?
It's just like, I'm just pissed off continuously where it's like, oh, should we do this? Should we do this? It's like, just fucking do it. Like, I invest in you because I trust you. Now execute. Do you know what I mean? Sorry.
Absolutely, I do. No, absolutely, I do.
And I find like running a company at the same time, I know how like I execute, do the same. And I know that sounds awful, but like, anyway, I will get off my high horse. I want to do a quick fire round, Mike. So I say a short statement. You give me your immediate thoughts. Does that sound okay?
Absolutely. Let's go.
So, I mean, you've got many books behind you. So what's your favorite book and why?
Well, no.
Well, I've read all of these.
So I like sort of fish out of water books, novels I'm talking about. So I try and kind of keep reading novels, where people go through conflict and they have to adapt and they learn about themselves, or they don't adapt. And you see what results. Some very different examples. There's Days Without End by Sebastian Barry. I loved. Don't Let's Go to the Dogs Tonight by Alexandra Fuller. It's sort of completely extraordinary memoir. I like Werner Herzog movies. I mean, it's all the same. There's a wide range, but that's kind of the theme.
Mike, I really just wanted you to say Sapiens, okay? I just wanted Sapiens, and you give me this intellectual shit.
It's not intellectual shit. It's like you should go and watch a Werner Herzog. I'll send you a Werner Herzog movie. It's visceral.
I would love that. I'll send you my favorite book as well. We can compare and contrast. You will love the Kama Sutra pop-up edition.
Is it painting by numbers as well? Is it?
Yeah, it's dot to dot. Tell me, what's the biggest weakness of venture partnerships today?
I'll give you two answers. There's the entrepreneur's experience of them, and then there's how they operate internally. So the entrepreneur's experience of them, it's the process. You meet someone, you explain your business. You then meet two people, you explain your business. Then you might meet the partnership, you explain your business again. You've repeated yourself 3 times at this point. Like that's not a good customer experience. So that's sort of one issue. I understand why it operates like that, but I don't think that's a great experience for the entrepreneur. And in the world of Loom and video, surely we can do better. And then, I think the venture partnerships solve for stability because it's such a long-term business. And there are these sort of carry handcuffs that sort of, vesting that encourage people to try and stick around. And I think that as a result, dissent is it's quite a big deal to have proper dissent. And I'm not sure there are lots of different ways of dealing with that. And, a lot of firms change for example, their voting processes and approval processes for investments quite frequently and they do that because the firms are evolving, but also no one's really got a good answer for that.
Yeah, I think that's a big challenge on the second one.
Actually, they don't have a good answer. It's an enduringly good answer. Maybe that's the best way of putting it, because the firms evolve.
What about this one? US VCs entering European seed deals. What are the thoughts and advice to founders?
If seed is an intrinsic part of their business, and they're prepared to get up early occasionally, rather than have every joint meeting start, on West Coast time, I think it's completely fine. Like this is a remote first world. Like, we're 15 minutes away from each other. We're doing this on video. So as long as this investment is important to them, then go for it. I would be very happy to co-invest with a good US VC on most investments I make.
No, I agree. Ed Sim at Boldstart's one of my favorites, and I think he's one of yours too. So I'm very pleased to hear that. Oh, I have one heavy
Miami Ed.
Well, I know he's very cool these days, isn't he?
Very Miami.
Selling on the way up. What did you mean by this?
It's two different things. And actually, a long time ago, there was an ABC, a Fred Wilson blog about this, about selling Twitter on the way up. But we build a portfolio, and if you can take money that looks like it's going to make another 3x and put it into a 10x opportunity that's earlier, that recycling is actively good. Now, you might get it wrong. It might turn out that you backed Twitter and it was a terrible mistake to have sold early, but you're backing your judgment about where in the portfolio will generate the most alpha today. So that's, if you're not open to that because you're wedded to not selling because something is a current winner, then you're sort of not really looking at how to optimize returns in your portfolio as a whole, as opposed to for a given atom. And we have different LPs, and there are LPs that want money returned sometimes. And if you are looking at holding something fully when there's a chance to get out, if it may be another 3 or 4 or 5 years before you can sell, then you need to look at not just what you think that company might make over the next year, but over the next 5 years, and determine whether it's fundamentally dilutive to your performance to keep going, or whether you should sell some of that stock. So my point is not that I want to sell. It's that you've got to sort of, as a manager, you've got to look, these are decisions. And in fact, and arguably, businesses where you are not prepared to invest, logically, if not emotionally, you're a seller. So, you just need to be open to examining these points in time as if they're decisions rather than, a round is happening, I'm just going to sit back. Sometimes that's the right decision, but you need to be open to weighing it up. I'm sorry, you're asking for quickfire and I gave you a speech.
So unfair of me here. Pro rata is a lazy decision. It's in between neutral. For me, I either do it or I don't do it. Agree or disagree?
I largely agree, but it's not every fund can lean in and do more than pro rata. Not every company has the capacity to bring in the investor they really want and allow us to invest more than pro rata, and sometimes not to invest pro rata. So it's a sort of useful artifact in the market. And there's, I think, a difference between what we can do and what we do. So, I think it's what you've just said is theoretically true, but not very practical.
Good. Glad I have your wisdom and advice then, Mike. Tell me, what do you know now that you wish you'd known at the start of your career in venture?
Oh gosh. I think basically a lot goes wrong. It'll be okay.
How do you deal with the really shit times, Mike?
If you've done your best, there's really nothing else you can do. And if you treated people well and with kindness in difficult times, that matters a lot. The biggest conflicts, I think, come when you're trying to hold too many different things in mind that are really not compatible with each other. And the quicker you admit that you've made a mistake, whether it's an investment decision or how you communicated with an entrepreneur, or when you prioritize work over family, or vice versa, you just got to be very, very honest with yourself. And I think that removes a lot of tension and weight from difficult times.
What would you most like to change about the world of venture, Mike?
I don't think there's enough mentorship. I think that there's it's partly because as information flow has accelerated and grown exponentially, and as we see with your business, younger and younger people have incredible access to experience, vicarious experience. There's a lot to read and absorb. I mean, young people today are so much better in the industry than when I was the equivalent age in the industry when I was starting. I mean, really, it's no contest. When I started, we had an information department in the basement at Apex. I had a fantastic woman, Jackie Meeks, who would help find a bit of information about a market if we needed it. And contents pages of reports are available on CD-ROMs. We faxed to her, and we would decide if we wanted a chapter or the whole thing. I mean, it's like so much information is available. And yet, I think that people going through the industry still need to talk and to bounce things off other people. So I think that there's people need mentors, I think.
That's
And you know so much. You've done almost 4,000, I think, of these shows, and hopefully some of them were interesting and useful to you. But when we meet, there's a lot to talk about.
Yeah, no, I mean, listen, I've been the beneficiary.
And I learned from you, by the way. I learned from you too. It's two-way.
I think that's the best mentorships. But no, I've been so lucky to have the mentors I have, and I wouldn't have been able to get through, I think, honestly, the hardest times without them. The good times, you can always do with advice, but I needed them in the bad times. And so I totally agree with you. I want to finish, Mike, on the most recent publicly announced investment. And why did you say yes and get so excited?
Sure. So the company is called Oply. And Oply it's creating, on the face of it, just an ingredients marketplace where manufacturers of small manufacturers of food brands or drinks brands source the ingredients they need to manufacture their products. But the team views it not just as a sort of how to enable commodities to be bought and sold, but as a messy data problem, and they believe that they can create the most transparent, predictive supply chain. So I love that because it's not just operating on one level, but on the level of sort of data and what that accumulated data with the right sort of analytics applied can enable. So that's very interesting to me. You know, what excited me is not just that sort of playing on multiple levels, but the team is this young team of two people who are really yin and yang, Helen and Martin, and Helen's this raw intelligence, drive, capacity to get an enormous breadth of stuff done well is really remarkable. And then Martin's this completely different character who covers a lot of ground as well, but in a very different way. And it's just exciting watching them evolve and addressing this really very, very large sort of multi-trillion-dollar opportunity.
Mike, as I said at the beginning, we first met like 7 years ago. I remember our first meeting. I'm so thrilled that we made this happen. I can't thank you enough for joining me, for keeping it to 20 minutes. I'm so glad that we nailed that.
I think one of my answers might have been less than 20 minutes, yeah.
But Mike, I loved it, so thank you so much.
Thanks so much, Harry. I really enjoyed it, and keep going. We all love the show.